Ladies and gentlemen, welcome back to the channel. The S&P 500 is up over 1.5% today. Why is this happening? Well, we kind of are getting a Fed pivot out of the UK. This is not Jerome Powell. This is not in regards to our market, but it's a big sign given the move that we have seen in bond yields. Potentially what could happen in America, and that's what is so bullish about today. But on top of that, what that is causing is the dollar to go down. Now think back to the last video and probably the video after that, where I have really broken down this whole dollar strengthening concept with you guys. It's not that the dollar is by itself, that the dollar's just becoming more valuable. In a way, yes, but how it works is the dollar derives its strength from other relative currencies. So what this means, the dollar has been going up. That means that other global currencies have been weakening. It also means that exporters, American companies, the largest companies in the world, are going to take a very large revenue hit when they convert their foreign currencies back to US dollars. So it's a bad thing if the currency just continues to go upwards. And literally, since the start of this whole market sell-off back in November and October of 2021, the US dollar has been strengthening. Really, the reason for it is the Fed raising rates and people wanting to own US dollars. People have been selling global currencies. Well, due to what the Bank of England has done today, those bonds, those currencies, global currencies, are starting to get a bid, and that is taking some of the pressure off of the dollar. It's not too often where you have a 1.25% down move in the dollar. This is equating to a very bullish market here today. And what the Bank of England actually did is very historical. And what has been happening with their bonds is also very historical. So this article says the Bank of England intervenes in bond market after historic sell-off. The key points: the UK gilt yields were on course for the sharpest monthly rise since at least 1957 as investors fled British fixed income markets following the new fiscal policy announcements. The measures included large swaths of unfunded tax cuts that have drawn global criticism, including from the IMF. That stands for International Monetary Fund. Now, what they're actually going to be doing is right here. It says the Bank of England will suspend the planned start of its gilt selling next week and begin temporarily buying long-dated bonds in order to calm the market chaos unleashed by the new government's so-called mini budget. Now, what this is quantitative tightening and quantitative easing. Here in America, I'm sure you guys know that the Fed is now selling $90 billion of bonds per month, and they're rolling those off of their balance sheet. Now, typically what the Fed actually does is control the short end of the curve. So what the curve means, the short end, that's essentially your 1, 2, 3 month bonds, your shorter duration, up to a year or two. That's what the Fed really likes to, you could call manipulate, right? The short end of the curve. The long end of the curve is more so for markets to figure out, right? Not too many people go out and buy a 3-month bond. A lot of people go out and buy 10, 20, 30-year bonds, and that is determined by the marketplace, by, in theory, supply and demand. So when the Bank of England comes out and they are going to control longer dated bonds, that means they are going to push interest rates down and stabilize that market. Because what has been happening over the last couple of days, the bond yields have actually been shooting way up. People have been selling bonds. The dollar amount, or the sterling or pound amount of these bonds, has been going down so much. There was a lot of large hedge funds, large call it pension funds, that were on the brink of going bankrupt because of this decrease in their portfolio holdings. So this would be the equivalent of the Fed coming out and saying, we're going to stop selling bonds immediately after we just started, and we are going to actually start buying bonds. That would obviously probably send the markets up, big time. And especially after we're seeing what we're seeing right now with the UK and that situation, it's definitely the main thing that is driving the markets today. And I think it's quite substantial given that we are at the lows of 2022 when they started to do this. So it could cause a lot of upside pressure. This could be a moment for the markets to say, hey, the Fed, they're not going to be able to raise rates as aggressively as they think. They're not going to be able to roll assets off the balance sheet at $90 billion per month if the UK isn't even able to do, I believe it was 15 or 20 billion per month, right? So when you put it into that context, there's a good reason why we are bullish today. And the Russell 2000 is well outperforming other indexes. The other indexes up almost 1.5% across the board, whereas the Russell 2000 is up 3%. And why specifically is that? Is because long dated bonds, right? The UK buying long duration. Well, what's that doing? That's pushing down the interest rate because it works like a dividend. The yield on a bond is fixed, or the actual payout is fixed. So when the price of the bond goes up, think like a dividend stock. The yield goes down. When the price of that bond goes down, the yield goes up. So what people are doing when the UK is buying these bonds, making the price go up, causing the yield to go down on a long duration outlook, right? The next 10, 20, 30 years, they say to themselves, would we want to own these bonds that are going to pay us 2 to 3%, or do we want to take our chances with some of the higher quality Russell 2000 stocks that should well outperform a 3% bond? That in a nutshell is what's going on here. I know it can get kind of advanced, but the main logic of what you need to know is that you are getting some form of easing of the monetary policy that we have been hearing. It has just been getting more and more aggressive, right? The Fed has not taken a break on the hawkish verbiage, on raising rates, on, stopping selling their balance sheet. None of that has happened. So this is the first sign of that happening. It's happening in the UK, which a lot of us could have seen that coming. I don't think this was too crazy out of the realm of possibilities, just because what has been happening in the bond market is very historic, especially over in Europe, but as well as in America. It's basically saying, long story short, that we're probably going to get a Fed pivot over the next couple of months because the economy, pension funds, hedge funds, fixed income investors cannot handle what is going on, and these very rapid movements, right? We're going up and down, yields are shooting back and forth like nobody's business. If you're not hedged out for that as a pension fund, as a hedge fund, you are going to get sloshed, especially on long duration, which should not move 0.5% in a day, right? That should not happen. You're going to get sloshed if you're not hedged out appropriately. So that in a nutshell is really what is going on today. And we have been talking about this quite extensively, really with the US dollar as well. And I think that is one of the big things. If we can continue to see the dollar come back down, even sub 30, that's going to be a very positive thing. Now, if we can really get the dollar to come down in a big way, that's going to be bullish. And I do think these events, they're multi-day events. It's not just one day, though the Bank of England announces they're going to, stop selling bonds. They're going to start buying bonds. We should go buy all the pounds, right? We should go buy these foreign currencies that are likely going to do the same thing as the UK and get ahead of it. That is the narrative that's probably going to play out. So this could actually start something very, very bullish. Really, from my opinion here, sitting here, this is a fundamental positive thing in the right direction, especially since we were at the lows hitting 358.71. That's a new 2022 low here in pre-market earlier in the day. And to see this sharp recovery, it makes a lot of sense why this is happening. The biggest thing that I would really watch out for is going to be this earnings season. Once you start to get more earnings that come out that might be really, really bad, that's when things could take another turn for the worse. But I think this is enough to get us a nice bounce, right? A nice relief rally. Not saying new all-time highs are coming anytime soon, but I do think you're going to be off the lows for a minute. And I do think roughly, even with my own technical analysis that I was doing, that I think it's very likely that you could go back up to, the 375 range on the S&P, possibly by the end of this week, and I do have some bullish trades on right now. That would be another 2% higher from here. If you guys want access to all of those trades in real time, link down below in the description of this video. It has been quite the ride. We also had some Apple puts, so it kind of worked out perfectly today. Apple got completely destroyed, and that's something else that we need to talk about here in this video, is Apple specifically, because what's been happening in the markets, a lot of people have flooded to healthcare. They have flooded to utilities. They have flooded to a lot of your energy companies, right? And energy sectors. Well, what I talked about in yesterday's video is the importance of seeing your utilities, your consumer staples that were the ones that were really outperforming to the downside, right? Those ones were deep red. Those sectors of the S&P 500 were deep red, whereas technology, consumer discretionary, those weren't doing as bad. And really the last one to go is Apple during a crash-like event, right? And Apple is down almost 3%. That usually doesn't happen when the NASDAQ and the S&P are up 1.5%. Apple is starting to slide today, and that is something we have to see to get to a market bottom. So it's actually a bullish thing. If we can continue to see Apple coming down, the lower Apple goes, the more bullish you have to become on the markets. It's quite counterintuitive, counter to what you think, but that is simply how this market works in 2022. So I just laid a lot of information on you guys. Feel free to run back, watch the rest, watch from the beginning again, and really try to pay attention to everything that is said, because yes, was a lot of information to put on you guys, but it is very, very important to know. Now, as far as AMC stock, the cost to borrow max sitting at about 30%, the cost to borrow average at 20.33%, and cost to borrow minimum at 1.21%. AMC stock is up about 2% at the time of this recording. Heading into the end of the day, why that's key and why that's good is obviously because we are green, but on the other hand of that, we were like 7-8% positive yesterday. So the fact that we are still green, upwards of 2 to 3% by the time you guys see this video, more than likely, right? That's a very bullish thing as well. AMC doesn't usually tend to string along multiple green days unless you are in a market uptrend, which indeed, maybe this is the start of one, but we're not currently there. So if we do head into a market uptrend, I think AMC would be a big outperformer. Now, nonetheless, as far as the option activity, you are seeing a lot of negative options coming through. Specifically, this one catches my eye, a September 30th $10 put for $1.52 million. Break even on this is going to be about $7.50 per share, about where we are right now. So if AMC can continue to go up, even though you have this very large order today, that's going to be a very bullish thing as well. That's going to show that at least that trade for the day is going against the hedge funds, and that would be a solid sign of a reversal for AMC for the broad markets. Now, the estimated short interest of free flow is sitting at 19%. Free flow out on loan sitting at 35.38%. So if these numbers are correct, there's a lot of shares that could still be sold short against us. That is also something we need to highlight and definitely pay attention to. Now, days to cover sitting at 4.21, and you do have 100% share utilization. Now, if we take a look at AMC on the actual charts here, we're sitting at a level, and we really bounced off of a key level, which was around $6.75 per share. You hit that, earlier in pre-market, right? And you could see, if we just draw a line right here, the importance and significance of this level. You've had multiple touches to this level. You've bounced off of it multiple times, and that's what it looks like here again. And usually when you do, the median return would be at least back up to the $10, $11, $12 range from that touch, right? You hit that, you went all the way up to 11.24, came back down to this level, not quite as low, back to the 50-day moving average, and then you went all the way up to, $16.89 per share, right? So technically speaking, as far as the charts, as far as the data that we are actually seeing right now, I would not bet against AMC. I would not bet against the markets, especially even on Friday, last Friday. We had the most puts ever bought in a single day for the largest dollar amount. Forget the COVID crash, forget anything we've seen in 2022. Friday might have been the capitulation day where a lot of people just threw in the towel, bought puts, said, screw it. It is what it is. I'm going to make this move, try to salvage the rest of my portfolio. But hey, that's usually when you do get a market turnaround. So that is pretty much going to be all for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Like I said, if you guys want to come trade with me live in real time, link down below in the description as well. Thank you for watching, and I will see you in the next one.